If you're anything like most people, you're going into the new year with the idea that 2026 is going to be your year financially. But the problem is most people is they either have no idea what they're doing, or if they do, they don't know where to start. So in this video, I'm going to talk you through a 7-step plan to achieving your financial plan and success in 2026. But if you're new here, my name's Ben, I'm a financial planner, and my aim is to help as many people as possible gain more clarity and confidence around their financial plan. Now, step one is probably an area which most people wouldn't ordinarily think about. The first thing you want to be looking at is protection. Now, when I talk about protection, that tends to turn a lot of people off. And that is a very normal reaction. And quite frankly, it's because it's not very interesting, it's pretty boring, and let's be honest, it's a bit morbid. The thing is, you need protection to be the foundation of your financial plan. The reason for that is because when you're, 15, 20, 25 years away from financial independence or retirement, your biggest asset is your ability to save money over time. Now, your ability to save money is dependent on you having an income. If you lose that income, your ability to save money and therefore grow your wealth is heavily impacted. So this is why, as financial planners, we always say that protection is the foundation of your financial plan. So what do I mean exactly by protection? Now, the three main ones are life insurance, critical illness cover, and income protection. Now, the order of importance varies depending on who you ask, but personally, I would say that your most important one of those three, particularly if you're in your kind of 30s, 40s, and 50s, is income protection. And that's, to the point I was making a minute ago, you need your income to be able to grow your wealth over time. So having that protection in place really does give you that confidence that that can be achievable, even if you were to lose your income for whatever reason. Now, some employers will offer income protection as part of your benefits package. So what you would typically see is that if you're unable to work for a period of time, your employer will pay you 75% of your base level income as an income whilst you're off sick. So what I would suggest is checking that first with your employer to see if that's something they offer. If they don't, you probably want to look at actually getting some income protection in place to at least cover your base level of expenses if you are unable to work due to sickness for a period of time. Now, the other two are life insurance and critical illness cover. Now, they are similar to an extent, to the extent at which they pay you a lump sum. So life insurance, obviously everyone's very familiar with that. If you die, it pays out a lump sum to whoever is nominated. Now, critical illness cover is, I would say, probably more important. And this is probably underpinned by the fact that you will see that critical illness cover is a lot more expensive than life insurance. Now, you might think, hey, well, why is that? Because I'm guaranteed to die, but I'm not guaranteed to get critical illness. So why is critical illness cover more expensive? And that's simply because whilst you have that policy in place, whether it's your life insurance or your critical illness cover, these typically run to retirement. Now, you're more likely to get a critical illness in that period than you are to die. And recent statistics actually show that 1 in 2 of us will have a critical illness at some point during our working life. So these two I would probably put hand in hand. You can typically get a life insurance and critical illness cover combined as one policy. So that's probably something you want to look into. And as a minimum, I would say you want to try and get a policy which pays a lump sum equivalent to any debts that you've had. Now, for most people, this is going to be their mortgage. So that's something you want to look into. And again, this is something that most employers offer. So again, before you go away and kind of take out any policies or do any research, I would suggest you check with your employer before you do that. Okay, so now we've got the protection out of the way. Step 2 is starting an emergency fund. Now, again, a lot of things you see online, and even myself have said in the past, that you want to aim for somewhere between 3 to 6 months of expenses. However, I would say that as a bare minimum to start with, you want to aim for 1 month. And I'll explain why in step 2. Now, the main reason for emergency fund really is things like a car repair, the boiler breaks down, maybe vet bills, for example, or anything like that. Now, step 3 may not be applicable to all of you, but step 3 is to pay off any high interest debt. And what I mean by high interest debt is any debt that you're paying more than 5% interest on. So for most people, this is going to be credit cards, personal loans, and store cards. Now, this isn't about feeling guilty or having discipline. This is pure maths. And the reason for that is because if you're paying 20 to 25% interest on your credit card, for example, you paying that off is effectively the same as you getting a 20 to 25% return on an investment. Now, if anyone can show me or tell me investment that's going to return that amount, then you're more than welcome to. But it's very, very, very rare for that to happen. So by paying off this debt, you are going to be saving a lot of money in interest over the long term. Okay, so moving on to step 4, and this is going back to the emergency fund. Now, you might think, okay, well, Ben, why have you told me to start an emergency fund, then move down to paying off debts, and then going back to the emergency fund? So the reason for this is because you having a small emergency fund in place gives you that breathing space to think more rationally, logically, and long term. So putting that 1 month of expenses in place actually then gives you the breathing room and buffer that you need to start planning on other things like paying down your high interest debt. So step 4, as I say, is emergency fund. You want to be looking to build an emergency fund of around 6 months of your expenses. So if your expenses are, let's say, £2,000 a month, you want to try and aim for an emergency fund of about £12,000. Now, as I've said before, this can vary the amount you need from 3 months to 9 months, which is why I've gone for the 6-month period. So this is going to depend really on kind of what your risk tolerance level is, how dependent you are on your income. If you are self-employed, for example, you might want to skew to the higher end of that. So maybe aim for 9 months just to give you that extra buffer, because clearly if you are self-employed, you are probably at a higher level of risk of having a more variable income than if you're employed. Now, step 5 is to maximize your matched pension employer contributions. And what I mean by that is that if you are paying into a pension through your employer, into a workplace pension, most employers will match up to a certain amount that you put in. So let's say at the moment you're putting in 5% and your employer's putting in 3%. They may say, okay, well, if you put in 10%, we'll put in 10%. Now, this is a massive, massive win for most people, and it's something that's massively overlooked. And that's because you not making the most of these maximum matching pension contributions is effectively leaving free money on the table. Now, I know people are going to say, okay, well, this is great, but I need the money now. I don't want it in my pension that I can't access for another 20 years. The thing is, you having that extra money in your pension in 20 years means that you have to save a lot less between now and then, because your employer is doing a lot more of the heavy lifting for you. And again, if we're looking at this purely from a mathematical perspective, then putting that extra money in is effectively the same as you getting a 100% return on your investment, because you're putting in a certain amount and they are matching it. So let's say you put in £500 a month and they put in £500 a month. You are doubling your money by doing that. Now, speaking of investing, this takes us to step 6, and that is to start investing in an ISA. Now, people may or may not know what an ISA is, but simply what an ISA is an individual savings account. Now, historically, you've seen 2 different types of ISA. You've got a cash ISA, which, as the name suggests, you have money in that ISA and it's held in cash, and a stocks and shares ISA. Now, with any type of ISA, this means that any money or any growth you get within that ISA is tax-free. So it's really important that you are using your ISA allowance each year if possible. Now, this is currently £20,000. This is subject to change moving forward, depending on if you've got a cash ISA or a stocks and shares ISA. Now, the benefit with this compared to a pension is obviously you can access it much sooner. So with a pension, any money you put into that, you cannot access until age 55. And this will soon be age 57. Whereas with an ISA, you can put the money in today, you can take it out tomorrow. Having that additional flexibility after you've made the most of the maximum matching pension contributions is the next step. And in terms of the ISA you want to go for, this is going to vary depending on your kind of time frame, your risk tolerance, and that sort of thing. But if you're going down the stocks and shares ISA route, I would say you want to go as simple as possible. Now, people have debates on, the best platform and the best fund, things like that. And really that is all noise. It doesn't really matter, because at this point, they're all much of a muchness when it comes to platform. The thing you want to focus on is the investment itself, because this is going to be the thing that actually drives your returns. Now, I'm not going to sit here and tell you the exact fund to invest in, because quite frankly, I can't do that. But the sort of thing you want to look for is a globally diversified index fund, which is low cost. Now, when I say low cost, you probably want to look for a fund that has a cost of somewhere between 0.2 to 0.5%. And Simply what this means is that you will be paying 0.2 to 0.5% of whatever value you've got in that fund each year. And over the long term, you would expect this sort of fund to achieve somewhere between 8 to 10% a year, depending on market conditions. Now, step 7 is to go back to pension contributions. And what I mean by this is once you've got your ISA in place, you're contributing regularly to that, you've got a buffer built up there for the medium term to access as and when you need, you want to go back to making those pension contributions. The reason for this is twofold, I suppose. The first is there are massive tax benefits to doing this. So any money you put into your pension, you're going to get tax relief on. So simply what this means is that it's going to be costing you less to put money into your pension than it would be to your ISA because of the tax relief. And secondly, your pension is going to be the foundation of your retirement plan. So for most people, that is their golden goose, I suppose, for lack of a better word. That is what they're aiming for, and that is their focus on retirement. So going back to your pension after you've got all your other things in a row is going to be the most important thing and the most beneficial thing for you to do. Now, the amount doesn't matter massively, to be completely honest, and the reason for that is because, you can only save what you can save. You'll see things online that say you want to aim to save anywhere between 10 to 20% of your income, and that's a good benchmark. But what I would say is don't put too much pressure on yourself to save a certain amount because, we all know there's been a cost of living crisis and there still is. People have commitments in life. You've got kids, you've got a mortgage, and quite frankly, you've probably got more important things to be worrying about than your pension. But any money you have got spare each month, you want to try and focus on putting that into your pension. Okay, so let's recap those 7 steps. So the first is protection, and this is protecting your income. This is the foundation of your long-term financial plan. The second is to build a 1-month emergency fund. So that's 1 month of regular expenses. This is to stabilize your cash flow and give you a buffer there should the worst happen. Step 3 is to remove expensive leaks. And what I mean by that is focusing on paying down high interest debt. Typically for most people, this is going to be anything above 5% interest. Step 4, build more resilience in your cash flow. So that's going back to the emergency fund, anywhere between 3 to 9 months of expenses in cash. Step 5 is to capture free money, and that is the maximum matching pension contributions through your employer. Step 6 is to create flexibility. That's through investing in a low-cost index fund within your stocks and shares ISA. And finally, step 7 is to grow your long-term wealth. Go back to making those pension contributions and really maximize your retirement plan as much as possible. Okay, so there you have it. There is my 7-step financial plan for financial success in 2026. So what I would suggest you do next is check out this video here, which talks about how much you actually need in your pension for retirement. This covers different levels of expenses from £2,000 a month all the way to £5,000 a month. But anyway, hope you've enjoyed this video. Hope you got some value from it. If you did, please do subscribe to the channel, because it really would mean a lot to me. And hopefully I'll see you in the next video.